button here. Todd is from LA. Welcome, Todd. I was in LA last year. Had a lot of fun. All right, let's officially start. My name is Jim Cagnano with Infinity Futures, and I appreciate everybody taking the busy time out of your schedule today to be here. We're going to talk about what I think is one of the most exciting futures events in recent memory, the micro E-minis. Before we do that, though, let me remind everybody, trading futures, options on futures involves substantial risk of loss, not suitable for all investors and traders. Oftentimes in futures trading, you have a high combination of leverage and volatility. And although that could be an equation for goodness, making money, it's also an equation for risk, losing money. So be careful. Only fund your futures trading account with risk capital. My personal definition, money I could afford to lose doesn't change my retirement horizon and doesn't overly anger Mrs. Cagnina. Now, I say that last part tongue in cheek, but stress in life matters, and it can carry over into your trading. So if you're not sure where you fit on the risk capital curve thing, give us a call here at Infinity. Everybody here is a customer service representative at Infinity, whether you like it or not, whether you're a customer or just kicking the tires or just here for information, doesn't matter. Use that free resource. Everybody here is Series 3 licensed, or I guess passed the Series 3 examination and registered with the CFTC, member of the NFA, and most importantly, or maybe as important, have many years of experience in dealing with these particular markets we're talking about and talking with traders from all over the world. So feel free to use that free resource regardless of your status as a customer or prospect or none of the above. Doesn't matter. David, good morning. Thanks for being here. All right. So I'm going to do I've been doing these webinars with GoToMeeting for at least 10 years, maybe longer, and this is the first time I'm going to try to launch an official poll question. So let's see if this works. In the poll question you should see in a second, I'm going to hit launch, and you should see it says, the question is, should we go long or short the micro E-mini NASDAQ? And I want you to vote long or short, because then what we're going to do, I'm going to pull up a chart. Hang on a second. We're going to pull up a chart. And this is actually an NQ chart. This is the big contract. This isn't the micro, but since the micro's new, we don't have daily data, right? We don't have daily data going back more than 9 days. So I'm going to look at a candlestick day chart, and I got a fib line drawn on there, and I have an average daily range drawn on there, and most of us know what happened on the open this morning. And so I want you to vote. Are we going to go long or are we going to go short? And then we'll unwind the trade. We'll unwind the trade at the end of the presentation, and we'll see how we did. We're going to do some other trade ideas also, but this is in a real-time simulated account. I'm going to pull up the Infinity AT trading ladder, and then we'll pop open the micro E-mini NASDAQ 100 June 2019 contract. And you can see the symbol in the upper left, MNQM9. And we'll just do we'll do a two lot. We'll do two micros for fun, okay? And the poll, so before when we did this last week, we just kind of said, hey, we verbalized it, right? We said, should we go long or go short? We kind of eyeballed it. Now I have some science. I have a poll in progress. And let me tell you, so far I hate to tell you, while the poll's still in progress, we're going to close this poll in about, no, Daryl, you can't type it into the screen. You got to vote in the poll progress box. Oh, you don't see a chart here, guys? Hang on. Oh, the poll's in the way. Oh, okay. See, again, I told you it was the first one. All right, so I'm going to end this poll. It's 50% going short, 39% going long. How do I end the poll? Let me click on Manage. Oops, no, that's not how you do it. I want to end this poll. Bear with me here. This is brand new. We're breaking ground. I'm going to close the poll. All right. So now let's go back to the chart. All right, so I learned something today, and this is how to do it. This is the chart. I should have showed you first before I started the poll. I did it backward. The poll results are this: 52% say go short, 37% say go long, 12% stay flat. So we're going to do what the people want. This is a democracy today. We're going to actually go short. And what I'm simply going to do is I'm going to pull up the ladder. I'm going to sell to at the market, and we're going to just let it go. You see it's a little bouncy, right? It's a little bouncy, but we'll let it go. I'm going to lower this, and we are officially short two contracts at 73.19 and 3/4 on the Infinity AT real-time simulated account. This is not real money, folks. All right, we're going to lower that. Thanks for playing. That was fun. Let's go back to our main event. So the micros, this is just a snapshot of basically the specs of a micro. And the idea was let's launch a product that's smaller than the classic EMini S&P, that's smaller than the and I'm using the word classic, right? The classic EMini Nasdaq, the classic EMini Russell, and the classic EMini Dow. And let's make them 1/10 the size. And let's shrink them down. All right, no worries. I muffed the poll. I should have done the chart first. They're 1/10 the size. And so, what could you do with a 1/10 the size contract? And the answer is a whole bunch of stuff. And the most interesting thing to me, nobody knows when a new product is launched, what's going to happen. And so I've been tracking the volume every day since the start, since May 6th. And this is everything. And you'll see on here, you'll see the micro S&Ps have the most volume so far, with over 3 million contracts traded. The Nasdaq, the micro Nasdaq, second with almost 2 million, and then the Dow is third, and the mini Russell is fourth, and for a total of over 6 million contracts traded already, and we're only in week 2. In my humble opinion, this is a phenomenal start. This is even though we've had extraordinary volatility, we have found demand for this product, and kudos to the CME group for coming up with it and implementing it. That's not easy either. So we have some volume here, okay, and we're going to focus on the EMini S&P since it's the micro EMini S&P, since it's the biggest one, right? And we know that it's the tick size is only $1.25 instead of $12.50, and we know the notional value is $5 times the futures price instead of $50 times the futures price. Okay, so it's a much smaller contract, but not that much smaller. When you compare it relative to a typical ETF trade, or even a typical options trade, you still have buying power at $5 times the futures price. And we'll talk a little bit about that as we go forward. The hours are the same with this market, with these indexes. Sunday afternoon, and this is all Chicago time, 5 p.m. Chicago time, Sunday night, the market opens up after digesting whatever happened in the news over the weekend, the geopolitical stuff or government activity or whatever it is. Usually Sunday night you have an impact. The market moves 5 p.m. goes all night, all day, all the way to 4 p.m. Monday afternoon. There's a 15-minute halt in the middle for reasons that elude me. We won't talk about that. But basically, for 11 hours in a row, you have a session. Now, that session is considered the day session, right? That's the day session. There's no night really. The night's only an hour long. It's from 4 p.m. to 5 p.m. As weird as that sounds. So the important aspect here is that day trade margins kick in from 5 p.m. at night, all morning, all day, all afternoon, until 4 p.m. And as you can see on the screen, the day trade margins are $50 a contract for this particular market. And again, it's a 1/10 smaller, right? It's a 1/10 smaller than the E-mini, the classic E-minis. At 4 o'clock till 5 o'clock the next, an hour later, basically, that's if you think about it, that's the night time. Markets are closed. There's no data. There's no trading. Nothing's going on. And then when it opens up again at 5 o'clock, the cycle repeats. So between 4 and 5, that's your overnight margin. And this is where things get interesting, because overnight margins are set by the exchanges. And the last time I checked, the margin for the micro E-mini was $630 a contract. That was a couple days ago I checked, which is 1/10 the size of a classic. So now we have the ability, many of us, depending on your account size, now we have the ability to not have to liquidate a position at 4 o'clock if you don't want to. If your contract is, if you're even a small futures account, and I'm going to say small, I'm going to say $1,000 is a small futures account, you'd still be able to hold one contract. On a $10,000 futures account, which is a day trading account, it's a bigger account, obviously, and I wouldn't consider it a big account, but it's you could hold more than one contract. You could hold many contracts. So that's one key part that's going to be critical on how you trade this thing, because now you don't have that 4 o'clock problem. Now you don't have a margin call problem in most cases. Okay, Stu says, what about flat over the day, flat at the end of the day? Well, in this particular case, the only reason if you have $1,000 account and you're either long or short one micro, you could hold that contract. You don't have to be flat at the end of the day. It's up to you, right? So it might be at this point, it might become a position trade or a swing trade that you might want to hold on to. So the margin's a big deal here. The margin's a big deal in this contract. It makes it and there's a lot of applications of why it's a big deal. Okay. So if you had $2,000 in your account, you'd be able to hold actually 3 contracts. So it's traded fractionally. If you could think of this as a fractional market, whereas one classic E-mini is one, and these are fungible contracts, right? And 3 micros would represent 30% of a classic. And we'll pull up some charts and we'll pull up some domes in a minute, and you'll see that the pricing is tight. The pricing is arbed to the tick in the micro E-minis. All right, we'll talk about transaction costs and all that stuff. I've got a few of those questions as we go a little bit further into the event. Again, this is a Chicago Mercantile Group market. Here's a snapshot of a recent depth of market, and we're going to explore what depth of market is in more detail. And you can see the bids and offers here are substantive. It's a big word for me. There's a lot of bid and offers here for a brand new product. This is a product in week 2. So we're excited about it, as you could tell. And so the ladder, we'll go over some of the things of the ladder. The ladder does a whole bunch of stuff. It allows you single click order entry. You can see the volume 10 ticks up and 10 ticks down, which you won't see most of the time in an ETF trade or a Forex trade or other types of smaller over-the-counter markets, CFDs, things like that. You don't get to see a transparent book, a transparent volume of market participants in real time, moving in, I don't know, milliseconds maybe. Okay. Stu says 2 line down. Ciao. First, sorry about my English. No worries. I don't speak very good English either. $50 margin per contract means if, for example, if you open 2 contracts, then the margin's $100. Yes, that is true. So for a day trade, a trade that you're going to initiate anytime after the market opens, and you're going to close anytime after the market, before the market closes, that's a day trade. The same session, buying and selling, or selling and buying during the same session is a day trade. And in your example, the margin for 2 contracts at a time is $100. The only way it goes to $630 a contract is if you decide to hold it past the close. You don't want to liquidate. You want to keep your position. Okay, so and then in your scenario, it would be $630 times 2, or $1,260 to hold 2 contracts past the close. Hopefully that was helpful. Hopeful on that. All right, so let's get off of this, right? Everyone's happy with that. I'm happy with that. Let's go back to the charts. Let's go back to, so all right, we talked about daily charts, right? This thing's only been around since May 6th, so you don't have daily data going before May 6th, but because of the market makers and because of the extraordinary volume and because of the arbitrage and whatever other auto programs are behind the scenes, you have a situation where the micro and the classic are priced the same all the time. And let me show you what I mean by that. I'm going to open up a micro ES and a regular classic ES at the same time, and we'll hold them side by side. And you can see here on the left-hand side is the classic, on the right-hand side is the micro, and pricing is in sync, 28.20 even, 28.20, 25. The pricing is completely in sync. And furthermore, in addition to that, and well, by the way, that blue line in the middle is where the last trade occurred. Gerald used the word confluence. I like that. The blue line going across is where the last trade occurred, or where a buyer and a seller agreed to do a deal. Now we know in futures trading, there's not buyers and sellers don't agree to do a deal one-on-one, but it's the Globex exchange, it's called, matches trades electronically on a FIFO basis, first in, first out. So that makes this even more extraordinary because the market is keeping the price the same, as it should. It's the exact same contract. As a matter of fact, it's fungible. So if you were long one classic, here's a good example. Here's a good application of these. Let's say you're long one classic. The close is coming up. You want to hold it, but you don't have the margin. Or, yeah, you want to hold it, you don't have the margin. But you do have the margin for half of it, right? You have the margin for half of it. So in this particular case, you could keep your long position in the EMini S&P, and you could sell 5 micros, right? So you're long one big one, you're short 5 micros. Your net exposure past the close is only 0.5 half of a classic to the upside, right? To the long side. So you've minimized your exposure by half. You kept your original long position, and then at 5 o'clock, when the market opens up again, you could liquidate your micro hedge, if you will, and be long one again. So that's actually a practical application. And I just used the one lot to keep the math simple, but think about it in terms of going into a weekend in the mini NASDAQ, where you want to stay long, but the big contract's a little too spicy. I'll use the word spicy. And you would like to water it down a little bit. So you could sell a few micros. So that's another, you have a lot of risk over the weekend. A lot of stuff happens over the weekend that, you can't do anything about, because when the market closes at 4 p.m. on Friday, it doesn't open again until Sunday at 5 p.m. You're frozen out. So whatever it is, it is. And if you gap up, you gap down, maybe it goes your way, maybe it doesn't go your way, but that could be a little scary. Ron, we did the close on the MNQ. We did the close on we did the trade on the mic on the poll question was for the NASDAQ, the micro NASDAQ. So no, I did not close it. David says, when you say 1600 hours to 1700 hours, are you referring to Chicago time? Yes, I always refer to Chicago time. I'm in Chicago. I started my career at the Chicago Board of Trade in the early 80s, maybe a little even earlier than that. I can't remember. I believe I was still in high school. And so the futures markets in my mind revolve around Chicago, even though maybe they don't, but they do. and I'm on Chicago time. So when I'm talking about time, I'm talking about Chicago time. So it's Central time here. Right now it's 10:20 in the morning. Okay, so we see how that works. And let me just give you an example of, let's do one of these fractional trades. All right, so I'm going to do a fractional trade, and so we'll buy a micro. Oops, I have a bracket there. Let me stop that. Let me stop the madness. All right, so we bought one there, and we sold one here. So, and we didn't get the exact fill because I mucked around with the bracket order I had, but this will halfway hedge itself, right? Halfway hedge itself. David asks, do you think micros might have a chance to become even more popular? That's a great question. And my hope and dream is yes. You can see we already have a tremendous amount of bids and a tremendous amount of offers. And for those of you who are new to futures, bids are basically track limit orders that are at the exchange. On the blue side, it's folks that or companies or institutions or whoever that want to buy at different prices, 10 prices down, or they want to sell. On the pink side or the red side represents limit orders on this where people want to sell. So you see people buy, you want to buy on the right, and people sell. I'm sorry, buy on the left, and people sell on the right, and that's kind of what you see there. So the volume's already pretty good, right? The volume's already pretty tight, and I think there's a couple of different classes of traders that are gonna benefit from this. Number one are folks that are brand new to futures. They're used to trading CFDs, maybe. They're used to trading just kind of regular equity markets. You're used to trading Forex markets, and those are all great places to trade. But now, and you might have, you have less risk aversion, and you have a smaller size account. You have a smaller size account. So the folks that want to, are going to have a smaller size account. This is a great way to participate. Number two is folks who've never traded futures before can now experience things that you can't experience anywhere else. A direct access level to 10 tick deep trading ladder. Single click order entry. Data and fills could be measured as low as milliseconds. You get to experience what that is, number one. Number two, you could learn, you could practice, right? Your trade strategies, your trade ideas, the way you do analysis, how to identify trade opportunities. You could follow along with leaders. Maybe you're in a chat room somewhere. Maybe you're listening to me. Maybe you want to experiment alongside. That's another reason. And then I think the fractional pricing thing is going to be good for hedgers and going to be good for people holding positions for longer periods of time. And then finally, the ability to scale in and scale out of a position. And we're going to do some examples of scaling in and scaling out of a trade. In other words, adding to a position or reducing a position after the market either goes against you for a period of time or goes your way for a period of time. Okay, and let's do that now. All right, so here we have a case where on the left-hand side we're long one EMini, classic EMini S&P. Our open P&L here is minus $75. On the other side, we have 5 micros. Our open P&L now is down to, I don't know, 1875, right? So almost half of this, right? It's almost a perfect hedge. Our entry price was a little off, but it's almost half. So now, if I wanted to add to my short position, I could simply do that incrementally. Okay, so I'm short 5 here, and let's say, you know what, this market might break down more. If it does break down more, I want to add another, I want to sell another contract. So let's, I don't know, we're 21 even. Let's go just randomly pick 28.17. I want to sell, oops, I did 5. My bad. Let's cancel that. See how fast I cancel that? Let's just do one. I want to sell another one at 27.18. And I think we're going to have more momentum on the downside, so I want to sell another one at 14. Right? So now I'm incrementally adding. I'm incrementally adding to my position as it continues to go my way. If I'm a trend trader, if I want to follow the trend, right? Now the market's retracing right now. Alternatively, I could say, you know what? I think it's still going to be a down day. I think it's still going to be a down day. So every time it goes against me on my position, I want to sell another one. And I want to sell another one. Because at the end of the day, I'm going to be right. We're going to end up, down big today based on my analysis. And I want to scale into these positions, right? I want to average my position in a way that when it does break, I'm in a good position. Is everybody with me? Okay. And actually starting with the 5 lot's probably the wrong idea, but we started with the 5 lot anyway. So we're going to get rid of this altogether. Let me show this example again. I'm going to go ahead and cancel all. I'm going to flatten. So the flatten button cancels everything. It makes me flat. All right. Now let's say we've decided we're going to go lower. Let's take a look at our chart. Actually, before we decide that, let's take a look at our chart. This is ES. We have a bottom here. We have a bottom here, 13, 14, and we're approaching a bottom here. We magically touched 28.16, or the 61.8% fib. And when I say magic, it's weird how it happens. It's weird how it happens. Fibonacci, don't take it lightly. In any event, so that gives me a clue. All right, we're finding buyers. We found buyers here. Let me do my tool, my ellipse. We found buyers down here. We have a little wick here. So maybe we're going to bounce off of this. So my perspective right now is maybe we should consider going long. Now let's take a look at intraday. This is a micro, not a classic, but a micro intraday view. And I have a volume profile here, triggered to start at the New York Open. So this volume profile actually is starting on the New York Open, which is 8:30 Chicago time. And you could see when the market opened up, we broke down pretty hard. We started at, I don't know, 32. We ended up down at 28 for a 12 handle hit. Okay, and then we bounced off and we kind of retraced a little bit, and here's where we are. So here's the volume profile, and in the middle you see the value area. Gray is the value area, and this pink line would be, from a volume point of view anyway, the point of control. Now this is different than market profile point of control, but it's point of control, and it kind of mirrors a lot of times the point of control for the market profile. All right, this blue, right, the dark blue is prices below value, and the dark blue above is prices above value, right? So this distribution is forming, this normal distribution is forming as we speak, and we could trade off of that as a trade idea. And there's a couple different trade ideas that someone might have, but we're going to go ahead with the idea that this market is going to retrace back up, and that we want to be long. So I'm going to go back to my trading dome here, if it will. And I'm going to go long one contract. Oops, one contract. Oops, I should have just went market. There we go. So we're long one contract. Now, using my market profile as a guide, if the market goes against us, let's open this up a little bit more. I want to end up adding to this position as it goes against us, which means as it approaches this point of control, I would like to, if it approaches this point of control, I'd like to add a contract, let's say around 28.19. All right, so let's go to 28.19. Let's add a contract at 28.19. Okay, so that's a limit order working 28.19. Now, how many times have we seen these profiles where, it's blown through them, right? All right, wow, man, I can't believe it went lower, but it did. Okay, so maybe I want to add another contract as we approach the bottom of the value area. If price is below value, 28.16. Let's add another one there. And then how many times have we seen it blow through there and make new lows on a big down, down morning, right? We've had a big down morning of 35 or so handles. And let's say it does that, it tests new lows at 214. Let's get long again. So in this snapshot that you see on the trading ladder, you see that we have a one lot position at 2150, and if the market continues to go against us, we'll have a second lot at 19 even, we'll have a third lot at 16, and we'll have a fourth lot at 14, conceivably, which would give us our average price somewhere in the middle. I don't know what it would be, but somewhere in the middle. Now, alternatively, I might be wrong. We might not retrace. I'm still long one. So if we don't retrace, it's a good thing because we're making money. If we do retrace, we're adding on, and we're going to have a better average price at a lower level. And we know markets won't go down forever one way, won't go up forever one way, and they kind of move around. That's why we day trade. Robin asks, are you using the standard ES plus one lot to hedge? In this example, I'm not. I flattened that. I flattened out that position. I closed that trading ladder. We're talking about scaling into a position when the market goes against you. Okay. Now, unfortunately, it's not going against us yet. So we're just gonna hang tight, and we're gonna wait, and we're gonna be patient. And this is the key when people talk about how do you overcome the execution costs. The key is scalping these markets are probably an exercise in frustration. It's only $1.25 a tick. So even if your execution fees were zero, it's still only $1.25 a tick. So the idea that these are scalpable in any meaningful way, in my opinion, is that's a tough road to hoe. Scaling in position trades and swing trades, in my opinion, are a better way to look at this, because it's not a $50 point, it's a $5 point. And when you see an average daily range of 20 handles times $5, that's only $100. So if you were to buy, and let me show you what I mean by that. Let me go to my other chart here. I'm tracking average daily range here, 30-day average. And right now we're pretty high. And we've had since the launch of this product, we've been pretty volatile. Right, so what are we at here? We're at 35, 30-day average is a 35 handle range, high to low. You buy the low, you sell the high, you make 35 points. Times $5, and it's not going to make anybody rich. On a regular day, we're closer to 25 handles times $5. It's $125 if you buy the low to sell the high. So the range itself, does it lend itself to scalping the market? Patience is in my opinion, again, patience is going to be the call of the day for these. And we see a lot of our customers doing just that. But patience makes it harder to trade, right? Patience makes it harder to trade. But But the easier idea is, because the risk is so low based on the overall capitalization of a position, that you won't sweat it as much. Does that make sense? You won't sweat it as much. All right, awesome. So we're going to sit here and watch, and it's going to take a while for anything to happen. Now, I put this trade on after the market opened, right? We started this thing at 10 o'clock, so it was a good hour and a half after the market opened. And, things have settled down, right? We're looking at volume profile or market profile to make trade ideas, because things have settled down. I don't know what news releases are left, probably none. And we're going to probably have some crazy stuff come out of Washington, and it'll move this thing around a little bit. But what I want to keep our eye on, the average price here. This is, right now we're long at 21.50. This is going to change when this is hit, when the 28.19 is going to hit, and it'll be long to, there we go, at 20.25. And of course, it's because we're trading in quarters, we round this up. So now it's a 2 lot. We're long 2. Our open P&L down at the bottom here is minus $12.50. Right? We're talking a cappuccino and I don't know, and one of those donuts they sell at Starbucks. So we're in a waiting pattern. Now let's say that nothing else happens. Let's say that nothing else happens all day. We're still long 2 around this area. It's 4 o'clock. You have the ability to leave. Leave it on. Come back tomorrow. If you feel that there are buyers here and there are buyers here, and that this is truly support, this area is truly support, given everything that's going on with the tariffs, given everything that's going on with the nonsense that we see every day on the news, given everything that's going on with inflation, interest rates, the things that we look at as traders, then I would be okay staying, holding my own here. I'd be okay going to bed tonight. Worst case scenario, what do we have? A 50 handle move, which would be on a 2 lot 100 times $5, which is a $500 hit, which is a big hit, but it's a lot better than a $5,000 hit. Okay, so I know I'm beating a dead horse, but I think this is one of the really good, in addition to the educational value of learning, what does a future statement look like? Folks who haven't traded futures, you get your future statement and you're like, what am I looking at? Because it's different than you get in it with an equity statement or with a Forex statement or with the in CFDs. Everything's different, right? We talk in terms of mark to market and net liquidated value, and we price things to the closing settlement price and all that stuff. So it's a little different. It's not hard. It's not rocket science. It's not confusing. It's just different. So that's the second application of this. How do I use a trading ladder? What is a limit order, really? What is a stop order? What is a stop order? Do I put my stop on the wrong side, right? It doesn't make sense. I'm long 2. A stop is going to be on the wrong side. It's going to be up here on the wrong side. There's my 2 lot stop. It's color coded. It's red. It's so easy. I understand it's red. Red's a stop. Blue's a go. It should be green's a go, but the line is a go. It's a limit order. Green is a limit order. This is a stop. I'm sorry. This is a limit order. I'm sorry. I'm losing my mind. I'm losing my mental faculties. I just placed a limit order up here. A stop order, we're long, goes below the market. Below the market. And it is red. Sorry, my finger was moving faster than my brain. So it's intuitive. You get to practice. Maybe I should practice more, but you get to practice putting orders in. Right-click to cancel orders. Putting orders in and dragging them to a different price. That's called cancel and replace. It happens almost instantaneously. So the other good news about the Infinity AT trading ladder is this really lends itself to to the speed associated with these volatile markets, right? When this market moves, it's easy to keep up. There, I just got out of one accidentally. I didn't want to do that. So I'm just going to buy it back. The speed of it, the agility of just right-clicking or left-clicking and moving things around as you like. So that's now we're back long too. Average price 19. We'll just let it go for a while. That's the other part of it. All right. Yeah, so your transaction costs matter here. I'm getting a lot of questions on transaction costs, and if your commission, if your commission is 99 cents plus the exchange fee, and you're a little over a dollar a side. It's a tick. It's one tick. It's one tick. So if you're trying to scalp ticks, it's a losing proposition. If you're trying to position trade more, it's not a losing proposition. Depends on how you want to apply it. So, and then Bob, talk to your customer service rep what you have going on. He'll take a look. SS asks, so it comes to taxes. Does each separate trade have to be listed? Okay, so this is a good question. So SS hasn't traded futures before. And what happens in futures trading, which is different than equity trading, is these are futures contracts. They're liquid futures contracts. Nobody's taking delivery. Everybody's flat at a certain period of time or rolls their contracts over. At the end of the year, beginning of the year, you'll get a 1099 that shows your profit and or your loss. You do not need to list every single trade you've ever done for the whole year and give it to your accountant. It's a simple 1099 P&L. One document, one number. So there's no hassle. So if you do, let's say you do 20 round turns, 20 buys and 20 sells in 1 month, one a day, or whatever you do, then it doesn't matter. You're not keeping a spreadsheet with those trades. They'll be on your statement and they'll be on your monthly statements. The record of them will never go away. But from a tax point of view, it's way simpler. I think that's your question, SS. If it's not, let me know and I'll try better. But okay. James asks, can you please show how to make a trade on the trade instead of the dome? Make a trade on the trade instead of the dome. I'm not sure I understand the question. All the trades I'm going to place today and that I would place in any event are going to be from the trading ladder. Now, you have an option. You could place a trade from the actual chart itself. I'm not going to go into the setup on how to do that in this webinar, but you certainly could place a trade right on the chart itself, and you could manage the trades right on the chart yourself, for sure. You could do that. I'm not going to go into how to do that. It's a whole separate webinar. We could do that webinar next week if you want. Thanks, guys. But we're not going to do that today. This is about the dome. This is about the micros, and this is about how to handle that. So, Mark, yeah, so Mark, I'm not saying you can't, I'm not saying these markets you can't day trade these markets on an in and out basis. You can, but what I'm saying is your targets and your limits in my opinion, to be successful, your targets and limits have to be further apart than they would in the classic EMini. The classic EMini is so big and could be dangerous that your stops traditionally for day traders are tighter and your targets are tighter also. Okay, right now we're long from 28.19, and it would be easy for us to take 6 or 8 ticks out possibly. It moves around pretty quickly, especially with today's volatility. So don't get me wrong, you could day trade these, and people are doing it, but you're not going to scalp them. I mean, you could, but it doesn't work. The scalping doesn't work for these because the tick size is too small, especially relative to your transaction costs. CS, I won't use your last name. I'll use your initials. CS says, what percentage of gains and losses are long-term, short-term? 60-40. 60-40. And so once you get your 1099, maybe you do your own taxes, maybe your accountant does them, they should know that. Wayne asked a great question. And I was talking with my associate, Mr. Bertuglia, Marco Bertuglia, earlier today. And the question is, can you spread these two things? As an example, and I'm going to use a different example than you use. I'm going to use a classic. Let me find my trade ladder here. Let's go to the mini NASDAQ. Oh, if I show the mini NASDAQ, we're going to give away where we're at. Here's the mini NASDAQ. We'll do the Dow, but the mini NASDAQ right now, we're up 34 bucks. We're short too. So in theory, let me pull up a I don't know. Let's pull up well, we could do it here. No, I don't want to do it here. Let's do one of these guys. M2K, Russell 2000 Micro. Let's do one of those guys. Whole lot of ticks here, right? A whole lot of ticks. So I'm long two, and let's say I long two micro. Yes, I want to be. Let's say I want to do the spread, and I want to trade. I don't know. Let's just say 4. I want to do the spread, which means I'm going to chase this thing down. I'm going to chase this thing down. Let's just sell for the market. There we go. So this is a spread idea, right? I'm short 4. And off the top of my head, I can't remember what the ratio is for a typical spread for the Russell versus the ES. I know that the NQ would be 5-2. So this is a spread, right? When the spread widens, you want to buy the spread if you think it's going to widen. You want to sell the spread if you think it's going to tighten, right? If you think the gap between these two different stock indices are going to change, the same way you would do the yield curve, right? You might do a 2-year note or a 5-year note versus a treasury bond, a 30-year treasury bond. You think the yield curve is going to change. You're going to, the interest rate spread between the two instruments are going to change. You would do a spread. You do that same way in the equity markets, as simple as the way I just did it. And you could hold, and not only that, who asked that question? These things are scrolling in so fast I can't even find the original question guy. Okay, Wayne says I did. Wayne, so the other cool thing about if you're going to leg into a spread here, and not, either a micro NAS over a micro ES or vice versa. Now you have the ability from a margining point of view, and they are cross-margined also, right? You get span margining credit for this, and it's going to be 1/10. So that margining ability helps folks with smaller accounts to say, hey, I'm going to hold this for a while. Maybe I'm going to hold it overnight. Maybe I'm going to hold it for a week. Maybe I'm going to hold it for 4 weeks. Whatever your analysis says the best thing to do is, you could do that now because presumably you'll have padding in your account to hold the position. And every day you'll get your statement and you'll see how you're doing. So that's a good question. And I don't know how many of our customers are doing these kind of spreads right now. To be honest with you, it could be quite a lot. I don't know. Or maybe not. But it's easier to implement these kind of spreads for sure because of the smaller tick size. Especially when you're doing, NASDAQ, typically NASDAQ ES is 5-2, right? You're doing a 5 lot and a 2 lot. And you're going to get some span margin credit, but you're not going to get 100% credit. It's not going to be a free trade. Keep in mind, spreads, though, you could lose on both sides of a spread. Keep that in mind. It's not a perfect hedge. It's not necessarily a highly correlated proposition sometimes. A lot of times it is. Sometimes it's not. So be careful with that. All right, so Michelle thinks it's 5-2 for M2K versus MES. That sounds about right. So we would add another position here to this to make it more copacetic. Oops, make that a 1. So we would add it. And the idea is when you do leg into them, you want to do it at the same time. So the pricing is aligned, for lack of a better word. Ruben asks, I am new to minis. Can you open a position and leave it open for a month? Yes, absolutely you can. Now keep in mind, futures contracts roll over every 3 months, right? We're in the June contract now, and we're eventually going to roll over into the September contract. In other words, the June contract is going to expire. That is a little different than some of the other markets you might be looking at, but the June contract does expire, which means as we approach expiration date, if you're, let's say you're long 2 micro E-mini S&Ps like we are now, you, at a certain point, as we approach rollover, it's called, you're going to sell 2 and simultaneously buy 2 in the new September contract. And then that's going to be good for 3 months. Okay, so you can't just buy one now and then, 20 years from now, when your son or daughter is ready for college, or 12, 15 years from now, whatever it is, and then see how much money you got in there. You have to have a little bit of an active management every 3 months. It's the nature of the market. Crude oil is monthly. Currency futures are every 3 months. Stock index futures are every 3 months. And they're the same whether it's a micro or a classic. Don asks, is there an ES versus... Okay, so let's hit on this again, Don. That's a good question. Is there an ES versus is there a classic ES versus a ES micro spread? And we touched on this earlier. And let me just pull up a regular classic dome. We'll hold it side by side. And you could see that the market is so tight, it's moving in harmony. There are 2 different markets with 2 different sets of buyers and sellers, but they're moving in harmony, which means the market makers and the traders, the volume is so good, and maybe there's algos going on here that eliminate any possible arbitrage opportunity with respect to me and you, because we are manually entering orders. And even if we weren't, this market is so tight, it's so in sync that you can't spread them and you can't arb them, I don't think, with this type of trading. I hope that helps. That helps. Do pattern day trader rules apply like stocks? Another great question. The answer is no. They don't. There's, like I showed in the introductory slides, you don't have to have $25,000 minimum account size to trade many of these futures. As a matter of fact, most of these futures. The micro mini account minimum is $1,000. If you want to trade the classic E-mini, which most people do, there's still a vast majority of traders, at least our customers, trade this big one here that I'm showing right here. This market is breaking down, isn't it? You know, we have customers trading it with, you know, $5,000 and less. And again, risk capital. So that's one of the good things about having a smaller, you know, smaller capitalization requirements. It's a more efficient use of your money. Instead of throwing in $25,000 to trade the equivalent size for spiders, let's say, you could throw in $5,000 and trade you know, a bigger EMini S&P contract. So that's kind of number one. Number two, we don't care how many trades you do or don't do. You know, I get people saying, hey, you know, I did a lot of trades. You should be happy. Like, no, I'm only happy if you make money, really, because I want you to be successful and do this a long time. And over the long run, I'll be happier. So we don't, it doesn't, there's no volume criteria. Some firms charge a volume criteria, some firms don't. We don't. You know, we don't force folks to trade. The only volume thing is related to the charting, and there's, you know, a charting fee. You know, it's $19.95 for charts. If you do 10 round turns in a 30-day period, then your charts are free. Almost everybody meets the 10. Not everybody, but most folks, most traders meet the 10, get the free charts. Otherwise, it's only $19.95. It's not a big deal. But from a commission point of view, or a day trade pattern point of view, or to characterize you as this kind of trader, that kind of trader, no, we don't. You don't have that obligation. You don't have that criteria, if you will, that you might have as a pattern day trader. I hope that helps the question a little better. Someone asks, what is the M2K? This is the Micro E-mini Russell 2000 contract. The Russell 2000 contract. So this is the greatest question of all. This is the best question ever asked by Greg. Greg says, I do not understand why you're adding to a losing trade with about 100 question marks after it. And the answer is, I probably shouldn't. And what I wanted to do is demonstrate the idea of averaging in using micros because of the small tick size. Would I do this with a regular classic E-mini S&P? Probably not. I'd be getting killed right now. You know, I'd be down, you know, $800 instead of $80. But Greg, I'm only down $80. And I'm long for now. My average price keeps going down. Now let's say I want to add another one. I'll buy a fifth one. I don't care. Let's buy a fifth one. And again, this is a simulator, so it's easier said than done. But my risk exposure here is small. And this, if I get filled at 28.12, my average price is going to go down as well. So during the course of a day, most days, of course, you have wicks at the end of your candles, right? You'll have, let me move this out of the way and show you what I mean. You'll have a wick. Let's get this thing a little more, better so I could, where's my little bar here? Come on, Jim. All right, so let's get rid of this, erase that. Let's get rid of this, erase that. You know, here's a wick. It's a high and a low, and we traded in the middle. Most days have wicks. Today we don't have a wick. We started off. This is a trend day, right? This is a violent one-way ticket to Palookaville. You know, this is down, 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 and it might be this way all day. It might be this way all day. But the concept I'm trying to show, and maybe you shouldn't apply it to a day like today where we open at the high and we keep going down nonstop and there's no wicks on the candles. The concept is, with the smaller lot sizes, we could average our way into a position and withstand and weather the storm, the up and down storm that you see on an intraday chart. Right. All right. Yeah. I know, Greg. I'm beating a dead horse on this thing, but did I just knock my microphone out? Anybody? I want to make sure I didn't. No, I didn't do that. All right. I get a little excited. The other, Daryl, thank you. I appreciate the kind comments. The other idea too is the reverse idea. So the reverse idea, instead of averaging, if you catch a trend, if you identify a trend, instead of adding to losing positions, adding to winning positions. And this is a concept that is psychologically difficult. The reason it's psychologically difficult is because nothing goes straight up, and usually, an exception of today, nothing goes straight down, right? So you have fluctuations. But the idea of adding to a winning position is less popular by most folks than it is. Let's just go back to this market. I'm going to flatten this out. This ES. Let's flatten this whole thing out. Let's say we've decided the long-term trend for this market is negative, is down. This is, we're going to break through all of this, supposed support that Kignina is talking about is BS. When we blow through this level, 2,800, we're going to zero. I want to be short. All right, so I have my micro, and I'm going to go short. We'll just sell one. I'm going to go short. Now, all along the way, over many different days, you don't have to add a second position today. You could add it tomorrow, or you could add it the next day. But if you think this is going to happen, if you're convinced based on your analysis and the fundamentals and all the things you believe is right in the universe, you think this is going to happen, then tomorrow you sell another one. The next day you sell another one. And the next day you sell another one. Pretty soon you're adding to winning positions. And it's not the popular thing. It's not the intuitive or instinctive thing to do, because you're actually changing your average price the other way. But I'll tell you, the micros let you, give you some ability to do that with some pretty good peace of mind and some smaller amounts of risk. So that's another thing. That's another thing to think about. All right, so Mike asks, are the charts free on the micros if you trade 10 round turns per month, just like the E-minis? The answer to that question is yes, Mike, it is. Nothing changes. It's absolutely the case. Steve, this is another great question. And I'm so glad I didn't have a PowerPoint prepared today, because you guys are asking all the questions that would be on the PowerPoint. Stephen, thank you. Are there any overnight interest or fees on positions? Let's hit the interest question first. The interest question is no, there's no interest. You're not borrowing stocks for this leveraged position. You're not borrowing stocks. And by the way, and I'll get to the second part on the fees. By the way, the notional value of this contract right now, you would take 2,814, let's round up, times $5, right? Times $5. So around $14,000 is the notional value of one of these contracts where you have $1,000 skin in the game. And you're not borrowing to get that leverage like you do in the equity side or any other side. I don't know what other markets are doing, but so the interest, it's a great question. No interest. Your money is your money. As long as you maintain your margin, you're good. The second thing is, are there fees on carrying over positions or opening positions? No, there is none. There is none. There's no fees. You got to have your margin. That's $630 per contract in your account, funded in your account, cash in your account. Give yourself some breathing room, because positions will go against you, or they will go your way, but they will sometimes also go against you. That's just the way it is. No one's buying the low every day and selling the high every day. So that's a great question. And so that's another reason why these markets are so much better than trading a Forex account. As a matter of fact, there's a micro Forex contract the CME offers, and we're going to do a webinar on that next week. we'll talk about the micro Forex contracts and why they're better than the regular over-the-counter, non-regulated cash FX market where you're paying interest and you're getting less interest back and the rolling positions over is crazy. So anyway, but we got people's attention now with the stock indices because they're so popular. All right, I'm kind of going all over the map here. It's 11:05. Tell me if I should like pull the curtain. Robin asked, do you need to close the current month and open the next month to roll over? All right, so I think we covered that. The answer is yes. Every 3 months, you're going to roll over. If you're holding a position for more than 3 months, you're going to roll over every 3 months. Can we do a spread for the micro? We did some spread examples. The answer is yes. Tony asked, are the transaction fees the same for mini contracts? No, they're not. They're lower for mini contracts. Commission's $1 aside. Exchange fees are less, 99 cents. Exchange fees are 20 cents. Regulatory fee is the same. Now, on that note, keep in mind, pretty much charting is free for everybody. We're not going to charge a liquidation fee if you go past your margin requirement. We don't charge a flat fee. We don't charge a routing fee, because this is all us. This is all in-house. This is Infinity Transact Corporation. I mean, this is we don't have to have a third party doing anything and getting in the middle or mucking up the works. That's why our data is so good. That's why the trading ladder is so good. So I think what folks are going to find out is at the end of the day, pricing is better. You're not going to get your pocket picked with some crazy fees. Okay, so SS asks a good question. If you have 2 contracts in a day and hold them through overnight, does the margin go up? Now, keep in mind, all right, so it goes from $50 SS, remember, I'm sorry, $100, because it's $50 a contract, right? So the day trade is $50 a contract, so 50 times 2 is 100. But if you hold it overnight, then the margin requirement does go up to $1,260, right? 630 times 2 to hold that position over. Now, if you're going to do that, you'll have more money than $1,260 in your account. You'll probably have a couple thousand, right? You don't want to be on margin call day one, right? Maybe it's 1,500. I don't know what you're thinking, but yeah, that you nailed it. You got the answer right. Okay, Don asks, can I hedge ES short with E micro MS long through the close? All right, the answer is yes, if you do it fractionally. Nobody in their right mind should sell 1 ES and then at the close buy 10 micros as a hedge. That's crazy, because you're going to have to unwind them. So if you instead of doing if you're short 1 ES and you want to hedge with 5 micros or 4 micros or 6 micros or 3 micros, that makes more sense to me. But if you're doing it 1 to 10, then no, you're just adding transaction costs for no reason. So just get flat. Just buy your ES and then sell it again an hour later. Buy your ES at 4 o'clock, sell it again at 10 o'clock, and hold it all night, if that's what you want to do. Again, the fractional idea is a good idea for hedging, or a good idea for reducing your risk. If you don't want to do a full one, you only want to do a half of a classic, then you could do 5 on the other side to make that math work. These are fungible contracts. I just made that word up, maybe. Maybe I didn't. I don't know. Okay. Larry, a live demo count is the easiest thing in the world. Let me show you real quickly what you're going to do. Let me show you real quickly. You're coming here. You're clicking on this green learn button. Green learn button. InfinityFutures.com, green learn button. Fill out this information. First name, last name, country, phone, email. Hit get started. You will automatically get an email that goes to you with a username instantly. We'll give it a couple minutes maybe, but right away you'll get an email with a username, a password, a download link, and a link and some links to some how-to videos and a phone number. Okay, and you can get started before I'm done with this broadcast. You could be clicking away. Okay, so I recommend if you haven't, even if you decide, you know what, I'm not going to trade with Infinity. I don't like Cagnina's an idiot. I don't want to trade with him, but I want to trade futures. Then do the practice account anyway. It's free. You know, it's free. And if we send you an email you don't want, hit the unsubscribe button. But again, this is tricky business, trading futures. It's hard to do. It's hard to do. And it's hard to be successful. And 30 days gives you a good launch window to say, hey, is our futures right for me or not? Are classic E-minis right for me or not? Are micro E-minis right for me or not? Do I want to actually fund an account? Yes or no? And then you could practice your trade ideas, your strategies with the real-time. This real-time simulator is one of the best real-time simulators I've seen. It really closely mimics the experience you'll have with a live account. The trick in the simulators is the limit orders, right? Because limit orders are, let me put a limit order in here. There's 522 contracts ahead of me. I just put a limit order in at 28.17, and those limit people, and I'm in line behind people. Now people have canceled their orders, so I'm getting closer to the line. But when the market gets there and trades at 28.17, then buyers and sellers are going to be matched, and that number is going to get smaller. I'm going to get closer to the front of the line. Now, if the market drops below that 28.17 and I don't get filled, well, my limit order is still sitting there. I don't get filled. If the market goes through 28.17 to 28.17 and a quarter, I'm guaranteed a fill. I'm blocking the market. It can't go past me without giving me my fill. That's how it works. So, and my point of the whole story is the simulator, we try to mimic that. We know that you're not going to be at the front of the line as soon as you put your limit order in the simulator. You're going to be somewhere else in the middle of the line or toward the end of the line, and you're going to chew your way to the front. The simulator is really good. I don't know what the algo is that these geniuses at Transact came up with, but it works really good. So it'll give you a good experience. That leads me to my second point. The sim, and I'll get to everyone's question. I'll stay here as long as you want. The simulator is good for a couple things. One, how do you place orders? How do you put a simple bracket in? How do you put a multi-target bracket in? How do you put a trailing stop in? How do you cancel and replace orders? How do you move your prices around? It's good to learn the trading ladder, and it's good to learn the feature-rich environment of the charts. How to use charts. That's number one. Number two is let's practice my trade ideas. Let's practice my analytical techniques combined with let's pretend this is real money. Let's go ahead and practice some strategies. Whether it's, it's an oscillator-based strategy, moving averages, combination, Ikamuchu cloud, however you say it, whatever, market profile, whatever your shtick is, you could practice it for free without risking no money. Now, the downside is, and this is really the value of the another value of the micros. The downside is there's no psychological skin in the game when you're trading on a simulator. The real fear and greed that kick into every single one of us when we're day trading futures is not there in a simulator. You don't have any money in the game. And no matter how disciplined you are, or no matter how tough you are, these chemical reactions, when real money is on the line, are happening in your brain. You can't control that. So in come the micros, where I could take the next step, right? I go from simulator to the micro. Now I got real money. Now I could start feeling some of these feelings and adjusting and learning discipline. And then when you're ready, you move up to the classic, or you move to crude oil, or you move to gold futures, or you move to the currency futures, or natural gas, or corn, or wheat or whatever you're interested in, wherever you find opportunities. Maybe you're trading all those markets. Every asset class you could get a handle on in the futures market: treasury bonds, interest rates, treasury notes. James asks, is it convenient to put a 1 minute chart on while we do this? Well, yeah, it's super convenient. So let's go to an intraday chart. Whoa, this is looking ugly. So this is a 30-minute chart. All I'm going to do is I'm going to use my keyboard to show you how it is. I'm going to hit the number 1 for 1 minute, and then M for minute, and hit enter, and it changes it to a 1 minute chart. If I want to do it, I could change it manually. I could set my smart keys up. Here's a 1 minute, 5 minute, 15 minute. It's convenient. It's absolutely convenient. Larry asks, does the exchange charge an extra monthly fee for the micros if we are already paying? Oh, great question. Another great question. I'm so glad I don't have a PowerPoint because they're boring and people forget. Now I could think about the answer properly. The micros are in the same bundle as the CME group data fees, which is $6. The transact charge is $1, the exchange charge is $5. It's $6 a month. It's included in the classic EMini. It's included in the classic EMini bundle. So no, you don't have to pay more. I think that's your question, Larry. It's included. If it's not on your trading platform, if you're a customer of Infinity's, it's not on your trading platform right now, just shoot an email to support@transactfutures.com and say, hey, add this to my account. Or shoot it to me, or shoot it to your broker. They'll forward it over to Transact. You can go directly to them to add this contract to your platform, just like that, and they'll do it right away. All right. All right, Stephen asks, can you briefly explain why did the micro EMini require market makers? Well, I can give you my best idea. When any new product is launched, a micro EMini, cryptocurrency futures, there's another recent one, Bitcoin futures, I think they're called. The exchange wants the launch to be successful, as do I, and they don't want the early customers to get ripped off on the bid-ask spread. The bid-ask spread is part of your transaction cost, like it or not. I mean, you're trading a U.S. Treasury bond. The bid-ask spread between the highest bid and the lowest offer is $31.25. It's not small. It's part of your transaction cost. So if it's a one tick market, or as the Forex folks like to say, a 1 pip market, then your transaction cost is less. Everybody wants the bid-ask to be as tight as possible to give fair pricing, to give you a shot. The exchange doesn't want to have a 5 or 10 tick bid-ask spread. It's not good for their customers. So that's what I think. I mean, I don't know, and it makes it more attractive, and of course it helps legitimize the market. And the CME group's good at that. They're really, really, really good at that. So I'm a big fan, as you could tell. But I think those are the two reasons. Now, my guess is on the market making side, maybe as this thing becomes more mature, then that activity goes away, and it's the true market. But the pricing is so in line with the big classic E-mini S&P that it is the true market. Pricing is great. Mike said that's one badass bid-ask spread. I don't know that it's a good question. I don't know the answer to that one. I'm going to look that one up. Maybe someone knows. How could I not know the answer to that? James says the game sometimes seems to be let's go hit the stops in reverse. Well, guess what? In a micro contract, you have more power to adjust that stop to below the reverse area, if you believe that's true. If you believe that's true. All right, I'm sure I missed like a million questions here. This was a big group. There's a few hundred folks here, and questions were the way the GoToMeeting works is questions just stream in a long list with the scroll bar, and it's hard to kind of see them all. So if I miss something, David's laughed. He says trend days down usually close near the low. It certainly looks like one of these days. Although we've seen miraculous turnarounds at the close also, so be careful. But from a market profile point of view, there's some pretty good trade ideas here. Yeah, Greg, that's funny. All right, I think we're good to go. I mean, I don't know what I missed. Alicia, you're going to be 99 cents aside. What is ES CAGs? All right, so ES is the EMini, classic EMini. CAGs is my nickname. You can call me CAGs if you want. Jim Cagney, short for that. That's how I name my chart. That's all. That's just the name of the chart. Okay, a couple of people asked about options. I believe the answer to options on the micros is a no. And that's a good question though, RD, because this is almost like an option, right? I mean, you're paying a little premium to get a position and to hold it for something to happen. I've had some people actually describe the micros this way, right? And the premium being how far our position goes against you, but being able to hold it on the event that you're going to have a big move to the upside or a big move to the downside. That's why we trade options, to minimize your exposure. So in essence, you could use this particular market to behave like an option, but there's not options on micros. I don't think there will be. Larry, you're right, per side. All in, you're going to be about one tick. You're going to be the difference between the bid and the ask. Stephen, thank you. That was very nice of you. Thanks for coming. Where did you draw your fib line from? I don't know. So fib lines are tricky, especially when you have a market that looks like this. But what I did was I took it from this retracement here. I don't know what's the date here. It's going to be around March 8th. That low. That candle was important. I mean, that candle, we had buyers come in and reject that low. We had buyers strongly come in. Look at that candle. Was it a hammer, a shooting star? I can't remember the name of that doji, but that thing was it's a classic turnaround doji, in my opinion. And so I drew it from there to the high, and been looking at these lines ever since. We've broken down through the 61.8%. If we make new lows here, I hate to say it, but we could be, what do they say? The market goes up like an escalator and down like an elevator. We can be in elevator mode south of 2,800. I don't know, but I'd be worried about that. So be sure you have your stops in, no matter what you're doing. Let's find out where we ended up. I'm gonna go ahead and get out of my NASDAQ position. Remember we had a 2-lot. Let me find it. Let me find I have all these, GoToMeeting has all these crazy windows up. So here we go. So I'm gonna flatten the position. I'm just gonna flatten. So in the time we were talking on a 2-lot in the micro, now that wasn't a day, it wasn't a scalp, it wasn't a short-term trade. I've been talking for an hour and a half almost. So an hour 25 minutes, we guessed right. The audience was right. The people spoke, and at least sim dollars, we made 173 sim dollars on a 2-lot in the micro. I mean, you know, so Larry, I don't want to hear the 99-cent violin. I'm teasing you, bud. Anyway, that was fun. That was a good time. I'm sure I missed some really good questions. I invite you to reach out. How do I put some contact information up here? I'm going to type it into the question box. Daryl, thank you for coming. I appreciate that. I'm going to send trade. This is easy to remember. Trade at infinityfutures.com comes right to me. And call the following number if you want to talk to me. I love talking to traders about anything. I went ahead and sent you that info. For those of you who like to Skype, I'm not always on Skype, but I'm usually on Skype. I'm going to send you my Skype handle. It is Skype is inf.jim.cagnina. Yes, you could call me Kegs if you want, or you can call me Jim, or I don't care what you call me. Steve says I should take that sim money and have steak for lunch. All right, thanks everybody. Michelle, thank you again. It's always good to see you. All the kind words. Thank you so much. Be careful out there. Remember, trading futures, options on futures involve substantial risk of loss, not suitable for all traders and investors. Good luck out there. Take care.